Okay, welcome everyone. Thanks for joining today's webcast titled Sell High or Sell Later, the Valuation Window Every MSP Owner Should Understand. I'm joined today by Reed Warren and Corey Kearns of IT Valuations. Thank you both for being here. This topic is one that we touched on quite a bit at a few industry events weeks back, and it stirred up lots of great conversations. So we're excited to continue those discussions and hopefully deliver some guidance around where the market is at, where it's heading, and what that means for you. And then before we jump in, I'm just going to briefly walk through a few housekeeping items. First and foremost, please do not hesitate to put any questions or comments that you have in the chat throughout any point of the webcast. Don't feel like you have to wait until the end. We've allotted plenty of time for Q&A throughout the webcast, and I'll be sure to keep a close eye on the chat. Today's session will also be recorded, and I'll have it sent out to you by this afternoon. So feel free to sit back and relax during this conversation. We also love to take these conversations offline. So if you or your team will be at an upcoming role-based Evolve peer group in Texas in early June, please reach out. We have team members who will be there all week if you'd like to set up some time to connect with us. And then finally, we have another webinar coming up in mid-June where we'll discuss tax strategies, credits, and structural decisions that can meaningfully reduce your tax liability before you sell. So if you're interested in joining that conversation, I'll post the link in the chat later on in the webcast. And then now, the gentlemen you really want to hear from, Reed and Corey. Reed, if you don't mind introducing yourself first, then I'll have Corey follow and we can jump right into the webinar.
Hey, happy to do that. Excited to be with you guys today. Reed Warren, IT Valuations, founder and CEO. Used to do it all, but I'm so grateful to actually have Corey Kearns with us. Corey's came from us from Greater America, and he's been really, he's been our Vice President of Mergers and Acquisitions now, really driving that ball forward. And so on this conversation, his input is so relevant to what we have going on. And as we it's an honor, guys, to be able to have this call with you. I want to just encourage you, probably on this subject more than any other, please jump in with questions. We're here to be able to address those. So take advantage of the Q&A part, and Taylor will be watching that to make sure that we get all your questions answered, or as many of them as we can in the time that we have. So with that, I think we'll just move forward. We had this debate about how do we introduce each other, because nobody wants to talk about each other. So you know who I am, but again, very grateful for Corey and for Taylor. I have been accused of pillaging Great America with hiring their best talent. So we've been grateful to bring both Taylor and Corey from Great America. So
I appreciate you doing my intro, because I think you're just trying to avoid my typical response is you sell the dream and I fix the nightmare is typically how I intro.
Right.
So
yeah. But really want to start at the macro level here, and just kind of work our way down to why are we seeing what we're seeing today. As we look at, I'm not an economist, so I'm going to start with that as we get into it. But as we look at these things, they do factor into transaction values and the overall managed services market. And so, first of all, we do see global GDP continues to grow about 3.1%, which is actually overall pretty healthy given all the stuff that's going on in our global economy. But again, as we see the global GDP go up, IT services, are built on users. Obviously, we have a big question mark around how AI is going to impact the number of users that we support. But certainly, as we go through it, the growing GDP is going to be able to continue to fund continued investment by the end customer into the technology stack. We'll talk about that a little bit more as we look at global IT spending, which has been ticking up over the last couple months and is looking really positive for the future. As we look at inflation has stabilized, and so about 3.3%. This just makes it easier for us as managed services companies to be able to provide ongoing support to our customers. Fed rates have retraced a bit from where they were a year ago. They're holding steady. And so whenever we see, as much as we'd like to see them come down, right now with all the instability in the market, it's great to see inflation stabilize, interest rates stabilize, GDP stabilizes, because it really is, regardless of whether it's high or low, that stability, that's what really creates a great business environment for everybody to be able to work from, and the end customer basically be able to consume from. So with that added, obviously, as we talked about stability, obviously, the Mideast continues to be creating instability, although that seems to be wrapping up now. And we anticipate, as we've seen things come out really from a macro perspective of the tariffs, which are about a year ago, which was a huge disruption. Obviously, the war in Iran has been a huge disruption. What that has actually forced so many of our the end customers to do is actually, it's created this really strong demand for reductions in cost, and how do they create operational resilience. And so what that's done is it's really moved particularly the managed service provider, from being just a MSP to really, again, this continued conversation around them becoming a total technology services provider, really being able to provide more support across a broader range of initiatives, from cybersecurity to obviously to voice to managed services to networks. And now even more so with AI, the demand for the MSP to be able to also manage and provide security and framework and infrastructure for all of our AI initiatives. And so, again, because of that instability in the marketplace and with the technology, it just makes the broader economy, or the broader end user, to be much more dependent on their infrastructure managed services provider to be able to support all those different pieces. This has helped really kind of flush out global IT spending, which is continuing to increase, is because it's becoming not only increasing differentiator, but as we see AI starting to take effect, it's also going to become really, from a profit center perspective, a higher level of efficiency from the business that should produce more profitability and reduce our dependencies on having a large workforce to be able to deliver the service set. So a lot happening with the global IT spending. As a result of that, AI is fueling that spend. And then obviously we're seeing AI, cloud and security becoming increasingly more critical functions. The demand by the customers to see SOC compliance and even going to SOC 2 to be able to maintain a security posture, especially as AI gets woven into it. Again, this is just increasing the ongoing dependence of the market on the managed service provider. And all of this, in the end, there at the bottom, is really fueling so much of the valuations and M&A that's happening in the space. The market, if I take a step back, private equity, when we saw the public market instability a year ago to the tariffs, most of the end consumer was really paused on doing a lot of renewed purchases on hardware and technology projects. For most MSPs were flat. We saw just even the managed services, but by most of our customers, was pretty flat the first half of last year. The result of all of that is private equity still had to hit their investment and their growth trajectories. And so we saw in the second half of the year, really all this money that was on the sidelines start to really get deployed to hit those growth targets through acquisitions. That's continued to fuel what's been to date our really supply and demand issue of more buyers today than there are sellers. And if we just jump ahead here, Taylor, to
Hold on, one quick thing.
Yeah.
Maybe counter thought here. Reed started jumping on you.
Yeah,
The
please do.
bottom two, though, I would say is a little bit contrary to what you're talking about. There is, depending on what I've seen in the market for managed service providers, depending on where they're positioned with their clients, sometimes does negatively impact them on those two bottom ones from a GRC and from an M&A at the client level, right? So do they hold the
Correct.
right relationships with the investors or maybe even the private equity owners, or are they forefronting the GRC conversations with AI coming down the pipeline? So I agree with you in general speak in terms of the macroeconomics going on here, Reed. But one thing at a micro level that I'm seeing with some MSPs is they've been negatively impacted more so in the last 6 to 12 months on client movement as it relates to
Right.
GRC, you know, and or you have private equity coming up and buying, HVAC or plumbing companies, whatever the down market may be, and they're actually losing clients to that. So it's happening at the broad level, and at the same time, I see it even at the micro level, that can positively or negatively impact them in terms of their client mix.
Well, I think you're really right. Because the M&A velocity creates both opportunities and threats. And so if
Right.
you're definitely in the seller, it's creating um, great opportunities if you're going to look at selling today. If you're looking to buy, it's really hard. I mean, Corey, you can weigh into that. It's really hard to buy today. Um, the-
It's easy. What do you mean?
so, um, a lot on that. But as we just look at just the velocity over the last, really couple years in 2022 was about 147 transactions in the managed service space, kind of going to 111 in 23 to 370 in 24. And then really looking at, 460 plus, we saw almost a 20% increase from 24 into 25. That velocity is continuing to accelerate here into 26. And we're seeing just a number of things happen with that from as with everything, what's happening in the marketplace does create both an opportunity and a threat. And as we look at just where the multiples are at today,
Read real quick. I'm pretty good at interrupting you. Sorry about that.
yeah,
Just at a high level, just to kind of recap for the group, because while you're not an economist, you do understand this stuff pretty well, right? For some of us non-economists, right? If you like two or three major bullet points here, right? From if you look at 22, 23, those are still pretty active years, right? At over
yes.
100 transactions done to nearly over 4 times that activity in 25. What would you tell somebody that isn't familiar with this space? Like, what are the two biggest drivers of what's causing this trajectory?
Well, I think uh, first of all, I said this carefully. Wealthy people don't necessarily want to work. They want to have their money work for them, right? And so
Sure.
when you look at public market instability, which has fueled so much of the movement to the private equity space, that the managed services market is such a low risk. It's just such a low risk industry. In fact, we
Yeah.
even see that in when we do the valuations. And so part of the reason we know we're in a bubble is because we do the valuations and what's called cost of capital. I don't want to get down a rabbit hole with cost of capital analysis, but one of the things you look at is what is the industry risk premium, right? So what is the interest rate that's applied to the industry? And we've watched that industry risk go from positive numbers. Now here actually in Q1, it's actually negative 0.6. So and it was at its high up around 2 when you look back at 22. So we're seeing two things happen. One, the because the managed services marketplace is very much like power to a business, it's infrastructure to the business. No business can really operate today without its infrastructure running, without its technology running. And so when you look at what does an investor want to
Mm.
invest in, they want to invest in those bread and butter industries that it's highly consumable, that everybody needs to have to be able to operate. And so as a result, it's extremely low risk from an industry perspective because today as an end customer can't operate without their website up, without their infrastructure happening.
Right.
That would be really the one of the primary drivers. And then second of all, which is right with it, so much of it is reoccurring in nature. One of the things that MSPs have so easily grasped is, hey, we want to put you on a subscription service that's predictable. Basically, for the investor, that creates predictable profitability for the investor who's buying into it. And so the combination of the industry dependence on the managed service provider combined with the great recurring nature and predictable profitability of it are really the two biggest factors that are driving the acquisitions or the interest from the buy side in the space.
Yeah, that makes sense. I just think it's helpful for people to kind of boil down, all that stuff into like what's actually driving that. And I think maybe even to layer in a little bit two very ancillary things that I would add to that, Reed, is like one, I think there's just from a supply, right? You've got a lot of
Yep.
boomers, right? Like just from a
Yep.
pure life cycle perspective, right? There's a lot of boomers in this window of time where they're looking at, right, from a succession planning perspective. And then I don't want to, I'm going to put it out there, and it's a topic for another discussion and webinar, but like the AI aspect and trajectory here is causing some people to reflect and say, do I have the right capital, resources, partners to kind of go through
Right.
this wave of next iteration of my business? And so I've seen even at a micro level, hey, Corey, I'm not really sure if I've got it in me, or I know we can really knock it out of the park with my client base as it relates to AI, but I don't have the right resources. I need to go find a partner to do so. So that's also, I think, that's fueling the things that you've added in there, Reed, from macro level.
But from that perspective, Corey, I mean, you've had the conversation with so many of our clients. How many of the, kind of current sellers that are on the market, would you say are, you know, where AI is one of the top three, how much of the market is that of the current people looking to sell their business
Reasons.
today is
Oh,
driven by AI?
I would say 12 months ago it was minority, and right now I think it's probably, nearly the majority of them are thinking that's one of the main reasons why they're contemplating it, right? Now, it comes down to different reasons. Some of them are just, I don't want to go down another iteration, and some of them are very opportunistic, where they know with the right partnership they can even accelerate. So I don't want the group coming out of this saying it's all bad conversations, because it's not. It's some of them are very opportunistic, saying is like, I just want to accelerate here. So it's definitely in every single conversation I have. And it definitely comes to when I ask somebody, it's like, give me the top three reasons why you're contemplating potentially going down a transaction. AI is coming up in some form or fashion.
Excellent. No, and so I think as we look at just kind of where multiples are at, let's just kind of track that out a bit further. We've seen on the bottom end, and it's our companies with $500,000 or less in EBITDA. We've watched really the peak of that market was in the 22, 23 timeframes. We've just continued to see that. I'm going to say retrace. If I were to go back to the pre-COVID days, a firm that was 3 to 500,000 in EBITDA was typically seeing a 3.5 to 4x multiple. That's sort of an industry norm. If you look at the transactions done over, the last 20, 30 years, that would be very much a normative range. And so as much as it feels like it's going backwards, it's actually settling back into that long-term historical average for where we see transactions landing 3.5 to 4x multiple. As we get to that, $1 million in EBITDA size, we've, been higher in 22, 23 timeframe. It kind of settled in a bit here in 25, but we're seeing, coming into 26, just because it's been such a seller's market, there's been such a shortage of sellers in the market. We see these economic factors, we see the private equity investments, we see the stabilization, that's occurring. We're seeing really 1 million and above, just premiums being paid for firms is candidly some of the highest, really, Corey, I mean, highest transactions I've ever seen from a multiples perspective on 1 million in EBITDA. If we were to go back a year ago, I mean, you had to really crush it to get,
Right.
above a 7.5. Maybe you could squeeze it out to an 8. And today, we have a number of transactions that are 1 million EBITDA that are looking steadily at nines. And the market continues to be, really hot on that. Um,
Yeah, we've been, I mean, not, I wouldn't say surprised. I'd say pleasantly surprised with some of the results that we're seeing. And then remind the group here, right, is we're still talking about well-run, what we would call like premium assets, right? Like these are businesses that are getting these types of valuations because they run a really great business. They're exceeding the expectations when it comes to true multiples at that $1 million range, where you typically wouldn't see those types of multiples until they're hitting, the $2 to $3 million tranches from an EBITDA perspective. So it's definitely, I don't, we use the word bubble, right? But it's definitely, continuing to incentivize, right, to continue on your business at a level that's, exceeding expectations, right? So it has been a interesting first 5 months of the year, I guess, is what I would say. And it's scary to say 5 months because we're gonna blink and it's gonna be June already here shortly. So
But when we look at it, we're seeing the dynamics change. We are seeing almost three to 4 times the number of sellers coming to the market today. I mean, some of the reasons for that is the last several years have been good, relatively good years for most MSPs. They've been able to kind of ride the rising tide of end customer demand, and there's not uncommon for an MSP to be seeing 10, 11, 12%, year over year growth rate, and not
Right.
really because they're taking market share. It's just the market's been supporting of that kind of growth rate. And so they've got a couple, they've got years of good performance to be able to bring to the table. We have the aging, kind of aging market demographics of the boomers looking to retire and move on. You also have the threat of AI as a disruption. And so we're seeing just a significant increase to the number of sellers coming to the market today. And so as we look at that particularly that 1 million in EBITDA space, we anticipate that market's going to start to retrace just because of the sheer volume of sellers that are coming to the table. And so it's not that the fundamentals will have shifted. It's the fact that buyers are going to start having more options where I don't have to pay a premium for this company because I can go out and I can, buy another company because of the volume of sellers that are coming to the table. And as we look towards 2028, as we get into another election year, which typically election years are super soft from a transaction velocity perspective, we do anticipate, again, when you look at most buyers, acquisitions velocity is high when you have stable marketplaces. And when you have, we'll see who's going to be running for office in 2028. But if it's Newsom and JD Vance, you got two radically different perspectives on the economy and business climates. And so we expect that the buyers are going to really put a pause on doing acquisitions in 2028, waiting to see who settles out of that fight before going back to make investments into from an acquisition perspective back in the marketplace. And so we do see at 28 some stuff will get done in early 28. By June of 28, we'll be and it wasn't dissimilar back in 24 either. We'll see a pretty soft period the second half of 28. And then depending on who wins the election and what the outcome is there, usually things start to pick up in the second half of 29 and velocity will start picking up back up into 2030. And so I expect 2030 to be another pretty good year from a velocity perspective, if we can see that far out. And so it really kind of comes back to there's this opportunity now to capture the market if you're in a position to sell. Otherwise, if you're going to be looking longer term and you're not able to capture kind of this wave, you do start to lay together a strategy for that 2029 and 2030 marketplace. And I do think, and what's sort of hidden in these numbers is the fact that if you are a top quartile company by 2029, you're still going to get the premium in the marketplace.
So I did see a question come through and it looked like Taylor. So I think we just answered it, but I want to kind of still discuss a little bit. The question there, Reed, was, why do we think the number of deals will go down in 28? And I think you answered part of that, right? There's an event or uncertainty in the market, right? Even
Right.
you could use an election that is one big uncertainty, but there's also things that are going to play out that are uncertain in the market that causes that. But also just sheer supply and demand, right?
Right.
Like you and I were kind of debating on this yesterday and the day before. Like when I look at that 20% volume of transactions in 2026, I think it's gonna be well above that based on even my
Right.
own individual
Right.
experience and talking with people in the market and in the space, right? So I think Josh's question was, why is that? And I think it's a factor of both. You have uncertainty in the market, and then it's purely a supply and demand as we think about the next 2.5, 3 years as we look outward. But anything else to add on that question, Reed, in
Yeah.
terms of why that
Yeah.
would
The only
be?
thing I would add, I think it's just really important for particularly people that are selling. A lot of sellers kind of think of, hey, I'm selling a business sort of like I'm selling a home, and I don't really
Hmm.
worry about what the buyer's going to do afterwards with it. And I think it's just really important to remember as you go through it. For the seller, it's all about the multiple, right? That's how I maximize value. For the buyer, it's all about the return on investment. In other words, how am I going to pay back this debt that I borrowed? How am I going to, what that future looks like? And so when you move into times where there's uncertainty around the future, not unlike what we saw even a year ago with all the tariffs, that created instability. And what happened to buyers like, hey, I can't calculate my return on investment when I don't know what the return's going to be and what the market's going to be like. And so I'm going to pause on spending money until I have confidence around how the public market is going to respond and how the end consumer is going to respond to that. And we saw the end consumer in 2025 also put a hold on, we had supply chain issues, we had a number of things. And so it's like, hey, I don't know that I want to make a big investment because they're concerned about their customers, right? And so whenever you have that uncertainty, that puts a challenge for the buyer who's really trying to figure out, is this acquisition a good investment? I can only calculate the value of that investment in the context of predictability. And if I have instability, I don't have predictability. If I don't have predictability, then I'm going to usually hold on to my money or I'm going to discount. I've got to start preparing for a much more worst case scenario. And so as you look at 28, it's not that buyers are going to not want to spend money. Buyers are just not going to be able to calculate, how do I get to my return? Because it could be two very different directions based upon who wins the election. And so as a result, I do anticipate the number of buyers spending, particularly from a private equity perspective, because they're the ones that calculate that the most. I think from what it does present for you, if you're a strategic buyer predominantly doing debt financing, it's probably going to be the best time to get some great buys. Because right now what's fueling so much of this, the frothiness in the market is private equity trying to acquire while they can acquire. I think, if I'm an MSP that's running top quartile right now and I'm building up sort of a war chest of cash, I would continue to do that through 26, 27, and then really take a look as the second half of 27 and starting into 28 to start to look at how do I deploy that now with debt financing to be able to do acquisitions where I'm going to be paying basically effectively a discount compared to today's market and be able to leverage that. Because if I'm looking at this and saying, hey, I'm just making this up, if I'm today a $1.5 million in EBITDA MSP, and by 28 I can grow from 1 to 2 million. Yeah, yes, my effective multiple went down, but if in 2028 I can now buy a 1 million in EBITDA MSP for a 6 to 7x multiple, that's going to take me from a 2 million EBITDA to a 3 million in EBITDA. My return on that investment, I just capture that return on my investment through critical mass, partly because we see those 3 million and above. There's still going to be this ongoing shortage of sellers in that $3 to $5 million MSP business. And so you have this way in 28, 27, 28, if you're a strategic buyer, to actually be able to still get to that return on investment, be able to sell in a premium as you acquire your way into that larger space or organically grow your way into that larger EBITDA volume.
That's something maybe we come back to, Reed, if we have time, because I can't count how many times I get asked the question on like, I'm not looking to sell right now, Corey. Should I put my chips into organic or inorganic plate? And that we might not have time, but I want to make sure we come back because you hit on that right there, Reed, in terms
Yeah.
of if you're a strategic buyer. But I know Taylor's trying to get some questions in here based on the chat, so I don't want to dive too deep into that quite yet.
Yep, we have a few questions for you, Reed. Juan asked, can we have some examples of an MSP that is on the lower end of the multiple versus an MSP that commands the higher end of the multiple? For context, I'm in the 500K EBITDA range.
You want me to start or you want it?
What was that, Corey?
You want me to start or you want to take it?
Yeah, go for it.
I mean, I think I think even there's a comment in there. I think one of the aspects you have to layer into this thought process is the revenue and the strength of revenue, right? Because it really depends if you're 500,000 in EBITDA and 5 million or $500,000 of EBITDA and 2 million of revenue, right? There's definitely other areas outside of EBITDA that we do need to make sure we're kind of keeping in context in this conversation. And then secondly, the other thing I would say that drives a big variation of where those multiples are is where you're at in your life cycle and journey of your business, right? From my perspective is it looks different if you've been running $500,000 of EBITDA and the same revenue for the last 10 years versus, hey, I've been in business for 3 years and here's what my trajectory looks like. So a lot of what goes into this is the strength and confidence in the growth in the retention of this business in the next 1 to 3 years. So there's a lot of variables, But I think in the less than 500,000 of EBITDA, it actually comes down to more of the revenue and the strength of the revenue. From my perspective, Reed, but I'd be curious if you have different
Yeah.
thoughts there.
No, I definitely agree. When you look at strength of revenue, though, there's a couple things I'll
Yeah.
layer into that. So strength of revenue is a couple of facets. One, how much of my revenue is reoccurring? And as much as there's a lot of conversation around reoccurring revenue, everybody feels like they know it. What we're really looking at is we want to see at least 50% of your reoccurring revenue being truly managed services, right? Where I'm providing a labor component. That labor component is your value add to whatever the product stack that's behind it. And so we want to see 50% that's in that managed service category, maybe another 25%, 20 to 25% that's in the recurring product category. So Office 365, Azure, there's a host of recurring software that you effectively resell. And then, typically seeing 20% or so in projects and maybe another 10% in product sales. And so when we look at the quality of that revenue, we're looking at how much is contractually obligated is really a key component to it. Also, when we look at the quality of revenue, one of the fun conversations too is really talking about net revenue expansion, right? And so in that net revenue expansion is how well are you growing within your existing customer base. So if you're growing, ideally, you should be growing somewhere between 10 and 15% year over year, just without even putting new logos on the board. That's just actually harvesting your customer base effectively. And so when we look at the quality of revenue, there's a lot of different aspects to it, but a lot of it has to do with how much is contracted, reoccurring, and then how are you actually managing your accounts and seeing good organic growth within your existing customer base.
I'm going to keep rolling here with the questions as well, Corey and Reed, because there's quite a few coming in the chat. Ronald asked, can you provide the associated revenue ranges associated with the EBITDA numbers provided? I asked because I am being told the revenue needs to align with the EBITDA.
Yeah, I would say very much so. I think for most of the examples here, we're talking about between 10 and 20% EBIT as a percentage of revenue. Certainly what happens, and we see this happening, is as you get over 20% EBITDA as a percentage of revenue, uh, you get diminishing returns. And a lot of that, and this is part of the reason that, to Corey's point, and Corey, you can elaborate further on it, we're talking about the quality of revenue. There's been so much conversation around EBITDA, but if you're running 30% or higher EBITDA, there's just not a lot I can do with the business. You don't have enough revenue for me to be able to materially change the value proposition that's there. Conversely, if I have a firm that's 10% EBITDA, um, as a buyer, I'm looking at go, hey, I can easily add 5-10% EBITDA value because I know I can harvest more out of your revenue. And so when you look at the complementary nature between EBITDA and revenue, when you look at that revenue, this is the potential market that you currently have today that is effectively under agreement with you. How much are you operationalizing from a profit perspective? That gives me as a buyer a lot of confidence. And so when we look at where are buyers sort of excited to pay some of the premiums, it's actually not at companies that are over 20% EBITDA. It's companies that are running 10 to, ideally right around 15% EBITDA. That tells me you have enough operational maturity, but it still leaves me room as a buyer to be able to bring that EBITDA level up because the seller will resemble the buyer in the next 12 to 18 months. So as a buyer, and particularly this is where private equity does so much work with is, hey, I'm going to buy a platform that's ideally, operating between, 17 to 22% EBITDA while growing organically, 15 to 20%. That becomes the platform because now every company I buy that's smaller than that is going to resemble that performance in the next 12 to 18 months. And so that becomes so much of that thesis in that journey. So yes, I would say these numbers are generally 10 to 20% EBITDA firms.
Yeah, even the relevant conversation I had this morning with somebody, it's like, well, Corey, I run at 30% EBITDA. I should get a premium. It's like, yeah, but you haven't invested in sales and marketing over the last 3 years, right? And so it comes down to more than just an EBITDA and the EBITDA percentage. And so that's why I think it's just really important for me to remind the audience and the market, yes, it is the primary factor of the valuation, but there's so much more that goes into it. And it's about the narrative and the long-term story and what's the future of the organization.
Well, and I would just touch further on that. When we look at it in today's market, and this hasn't always been true, but for the most part in today's market, we're seeing almost regardless of your profitability, companies are selling at 30 to 40% of revenue. So if I run a
Sure.
$5 million firm, I can pretty easily get a, a $2 million offer on the business, just simply because I've got revenue there that a buyer's going to look at and say, I know I can harvest that. Conversely, we see the other end taking effect as well. And so this is, I would say, is true for firms, under 10 million in revenue. But typically, if you're under 10 million in revenue, it's almost impossible to get more than 2 times revenue, just
Right.
because there's not enough revenue there for me to be able to make it any more. I don't care how profitable you are, I just can't squeeze any more out of the proverbial turnip. So as you look at it, if you're running at that 30% EBITDA, well, your multiple will become limited at whatever 2 times revenue is. Because if you're example, if you're 3 million in revenue and 1 million in EBITDA running 33%, you're not going to get a 7 to 9x multiple. You're at the most going to get a 6x multiple, because that's 2 times revenue.
Right. Right.
Another question from Patrick was, what are the forecasted multiples for a company with 750K in EBITDA looking to sell in 2029 or 2020 or 2030?
So
Go ahead.
probably, I think it's going to be similar to that 28 forecast. And I think, it really depends. That 750 really kind of depends. Are you an upper comer and you have the potential to continue to exceed expectations? You're probably going to fall closer to those million, to potentially even $2 million valuations. But, I'd use a proxy, use a median of the 500 and the million, but I don't think they're going to materially look different in 29, 30 from that 28 forecast. And I think Green and I would both love to have a crystal ball to say,
Right.
here's what it's going to look like. But there's a lot of movement in the market that it's going to be even more challenging for us to put a stamp down that says, here what we think 29 and 30 looks like. But I don't, unless you disagree, Reed, I don't think it's going to look materially different than 28.
No, I don't think it will, but I think here's the piece that I want to, coming back to the revenue conversation a little bit. Um, it really comes back to your trend, right? And so when
Mm-hmm.
we see companies that are built a good organic growth strategy, that are running 15 to 20% top line growth, you're going to be at the upper range of
That's
any
right.
of any of these ranges, right? In the end, it's easier to take a growing company, make it profitable, than to take a profitable company and make it grow. And
That's right.
so, as much as the conversation here is about the EBITDA piece to it, it doesn't do it justice. And this is what we get into when we do valuation work. If you've been at $1 million in EBITDA for the last 20 years, that's great. You got a business that has great cash flow. That's good, but you're not going to be at the top end of the range, simply because you don't have the growth there to be able to support it. If you're a company, this is where we talk about the rule of 40 quite a bit, where if you have 20 to 25% top line growth at 15 to 20% EBITDA, you're running at maximum efficiency. So the rule of 40 is really this efficiency scale that says, how much more can I drive out of the business? If I'm running completely efficient at a rule of 40, then I'm going to be looking at, I'm achieve max, really kind of that maximum velocity. So if you've been running, 5 to 10% growth at, even at 20% EBITDA, there's room to be able to drive that growth rate up. And so the growth rate is far more under your control than under the market's control. So if you're looking at how do I maximize things in 28 and 29, today I would be investing, especially if you're looking at that time frame, really investing into having good sales and marketing strategies to be able to get your organic growth rate north of 20%. And a lot of times that feels overwhelming for most managed services firms, because they're like, how do I even get close to that? That's not putting 20% new logos on the board. That's actually making sure you're doing account management well. And again, if you look at the account management numbers, I should be getting, ideally 5% just in rate increases. I should be getting another 3 to 5% out of cross-selling and upselling. And I should, even if my customers are growing at inflationary rates, I'm getting another 3 to 5% inflationary growth. I put that together. Good account management should be getting me somewhere between 12 and 15% year over year organic growth. Now, when I put a marketing team onto that conversation, or sales and marketing team onto that conversation, that's where that sales and marketing team can drive another 5 to ideally 10% new logo growth. And that's how I'm stringing together a business that is performing at a 20 to 25% top line growth and can sustain it really kind of indefinitely.
A few more questions here coming through the chat. Ryan asked, you're forecasting multiples holding strong through 2027. Is that model incorporating any assumptions about how AI agents may change the underlying unit economics of MSPs, whether that's margin expansion from labor displacement or pricing pressure as service delivery costs drop across the industry?
It's a great question. I personally think it's a longer tail. Like I mean, 27 is not that far away, as weird as that sounds, right? So I think there's definitely going to be disruption. I think it's a really great question. I think there will be pressure for sure in that regards. And I think that has impacts in the future valuations as we think about this business. But I think it's going to have a longer tail. And I personally think there could be some other kind of whiplash. If you're getting too far into AI, are we thinking about that GRC concept with our clients, right? So I haven't quite seen it hit the market, and I would love to see individual MSPs that are starting to capitalize it both internally, but I think there's a difference in utilizing it internally to either, maximize margins, and then there's also another element in terms of how do you commoditize that into the marketplace. And I think that second part is going to be a longer tail that we quite haven't figured out as an industry. But I saw a 5-minute pop-up that we have in this meeting. You could spend 100, a whole nother webinar on that, but open up to you, Reed, to see what you thought on that
Yeah.
question.
One of the things that people were expecting the market to do, similar to when, cybersecurity became this big rush, anybody that had any sort of cybersecurity tool, buyers were paying premiums for to be able to get on, to buy an asset or an intellectual property that would accelerate, their own growth. We haven't seen that happen with AI, and I think that's because we haven't seen AI make its way to IP, right? So I can create a cool tool with AI that I could maybe take to the marketplace. But the reality is it's really hard to make that intellectual property because basically if you give Claude the same set of prompts I did, you're going to get a very similar result. And in the end, Reed doesn't have anything that the broader market doesn't have access to. And so we just aren't seeing that kind of premium multiple being impacted as far as tool sets developed by AI. Where we are seeing the multiples get lifted by AI is really because it starts to create operational efficiency that turns into profitability as a result of the primary factor on AI. So I know we're coming up on our time. I just want to do two things real quickly as I was looking at the chats. I just want to call out Pat Lonergan, who's on the call. If you guys need somebody to help you with tax strategy and really, I should say tax strategy, really wealth management and tax strategy and really how to optimize, make sure you don't give the government any more than you have to. Pat Lonergan's the guy to talk to on that. He does wealth management, does a phenomenal job. If you send us an email, I'm happy to connect you to Patrick. He's one of our partners and has just done a phenomenal job with our clients, making sure we help make sure you get the most out of your transaction. Pat will really help you make sure you keep the most out of your transaction as a part of that journey. And so really appreciate Pat being here. And then also, I just want to call out Linda Rose on the call here. Linda and I go way back and have a great friendship. We're sort of coopetition today. If there's somebody that I would be willing to lose to in the marketplace, it would be Linda Rose. Linda does a phenomenal job with transaction work. She wrote a great book called Get Acquired for Millions, if that's right. Linda, you can drop it in the chat there for everybody to see, but highly recommend her book. And she's done a great job over the years supporting this market and really speaking into it with good, sage M&A advice. So.
Read to that point.
Yeah, as I say, Taylor, I don't think we're gonna get to all of them, but what we can try to do is, we can try to respond back in the chat to some of these, these questions at the best of our ability, but there's a lot coming in. I can't keep up with them, so.
Yeah, I don't mind, if people have the time, we can continue to go up until the top of the hour, so. We'll do that.
Taylor, you
If
get
you
your
have to
hands
drop
full, keep
off, we
going.
totally get it, but the recording will be made available, so.
Yeah. Reed, speaking of Linda Rose, she did have a question. Do you see any discounting of US PE firms buying Canadian MSPs?
I'll let Corey jump in on that one because Corey, we've been working on a couple of transactions in Canada.
I think what I would first say, it depends if they're already in Canada, is the first caveat that I would put, right? If they're already established in Canada, I don't think there's much change. I think if you have a primary US private equity firm that's looking to expand or build out in the US, they're pretty thoughtful before they enter into Canada, just given the complexities. There's obviously way more regulations that come into play there, especially from an employment perspective. So, yes, in general, Linda, I would say, but it just really kind of depends on the opportunity. For the right opportunity of scale and size and an opportunistic investor, I don't think there's much difference, but they are way more thoughtful before they kind of enter into a new market. And that's to be true. You could insert any new market. It doesn't just need to be Canada. It could be the UK, it could be New Zealand, it could be even certain states within the United States as well, right? So I think we just insert new market into that as well.
Yeah, and the piece that I think I would add to that though is we are seeing a lot of our established private equity firms that have been playing long in the U.S. market really start to expand into much more of a global market, partly because of the competition, the competitive nature of the U.S. market right now. There's so many new private equity firms being launched that have capital and they know they have to buy their way into the market and they're willing to pay a premium to get into the space. It's created a lot of tension when you look at a lot of our longstanding private equity firms, New Charter, Courser, Thrive, Evergreen. They've been around a long time, and it's been this influx of capital that has had a lot of new private equity firms launch is part of what's driving up these multiples. It's hard for a lot of those established firms to be able to effectively compete because of those premiums, and they're starting to look at some of those. I would call it sort of secondary markets that we can go to and not have to pay quite this level of premium like we're paying in the U.S. And the Canadian market is a really good market, very stable market. Operational maturity of MSPs is really good. As a general rule in Canada, it's a smaller market than the U.S., but we are seeing some definite interest and movement of U.S. private equity companies into the Canadian market, and then, as Corey mentioned, really other markets globally, whether that be New Zealand, Australia, UK, EU.
We can take some time following the webcast to answer some of the questions in a little more depth. But Corey and Reed, do you want to take just a little bit of the time that we have left to touch on organic versus inorganic growth?
Go for it, Corey.
I think you did. I mean, you framed it up pretty nicely, Reed, in terms of it really depends. We get asked this question a lot, and it really just kind of depends on what's the long-term strategy of the business. And the first thing I encourage people, a lot of times it's like, oh, Corey, I'm struggling to get organic growth, so I'm just going to flip to inorganic growth. That seems easy. Yeah, that seems pretty easy, right, guys? No. So I think you just have to do a lot of self-reflection to say, like, what are you really good at? And let's continue to pour in that. Because what I remind a lot of principal owners is who's going to be doing that work if you haven't already established a process or a team from an M&A perspective? Because if it's you as an owner, is that actually going to be a detriment to your current business? And so you just have to be really thoughtful before you launch in to say, oh, I'm going to go acquire, and here's the reasons why. Because while that is a great strategy, it can also be a distractor. And so I'm taking a little bit less mathematical answer to this question and more from just an understanding of your business and what's going to provide you the most value, because it's not always the same. Like one size does not fit everybody here. So I would just encourage you to do an assessment on your business before you enter into M&A, because you can't go in half-baked, is what I would tell you from my experience in working with a lot of people in this market.
Yeah, I would totally agree. I think the reason why organic growth, I would value organic growth, well, and the reason why organic growth is valued higher than inorganic or acquisitive growth is simply because it's sustainable. So if I build a good growth engine and I'm able to grow at 20% year over year, that means I'm always growing, right?
Right.
If I have to acquire my way to growth, that means I have a suboptimal growth rate. And the only way I grow is I got to spend big chunks of money to get to that growth. As a buyer, it's like, well, I'm less interested in that because I can go do acquisitions just as easy as you can to be able to get to that growth rate. And so when we see where does the premiums in the marketplace go to, actually your organic growth rate is the number one driver or the number one lever you can pull to change the value of your business. And we typically see for companies that are growing, twice the market, so 22 to 25% top line, will typically get not only the top end of the range, but they'll typically get 1 to 2 turns above whatever the average is, just because they have that growth rate. And
Yeah.
so I would just say the challenge with growth rate is this: if I invest today in sales and marketing, it's going to take 2 to 3 years before that growth rate catches up to my investment, right? So if I'm looking at 27 and saying, hey, what's the best way for me to change the value of my business in 27? Reed said growth rate's it. You can't make the investment today and harvest it that fast. And so, as I sometimes say, hey, 9 women can't make a baby in a month. There's only so much you can do to be able to drive up that growth rate. If you're looking at a 29 or 30, 2030 kind of time frame, yeah, today I would be really looking at how do I build a good sales engine, good marketing engine. How do I really become, AI optimized from a search perspective, and really be able to capture that organic growth rate. And then from there, if I'm building up a nice war chest of capital, then I start to take a look at, so what is the best time from a marketplace condition that I'm going to get the best return on investment from an acquisition perspective. And so if you're going to become a platform company, or that's your aspiration, a good platform company is one that has good organic growth, that's also done a number of acquisitions along the way, but now they're able to transform those companies they've acquired from a suboptimal growth rate now to an optimal growth rate, because they built the optimal growth rate engine through those sales and marketing initiatives.
The other thing, Reed, that I think will be interesting for us over the next year to two, we're starting to see, organizations that have done a lot of acquisitions over the last 3 to 4 years, right? And now they're actually looking at potentially, transacting themselves. And so we'll actually be able to look at the data, right? To your point on from a valuation perspective and from a revenue multiple to kind of actually track from an industry perspective on that inorganic versus organic, because, you had the, COVID window of acquisitions, and now you're starting to see kind of, I'll call it like the strategic second bite, right, where they're actually looking at exiting. So I'll be curious to see when we start carving out that data within our valuation, to actually show and tell everybody kind
Yep.
of here's what that looks like. So
I know we're past our time. Any final comments, Corey or Reed, before we wrap everything up?
I would think,
go
oh,
ahead,
sorry.
Reed. No, go ahead.
I think a couple of things here. I would say don't be intimidated by the market. It's oftentimes, I know, and I say this as an owner, so kind of many ways from one owner to another owner. The market has always looked cloudy and opaque, right? There's very few times where you go, oh my gosh, the market's going to be just raving and great and I can run forever, right? And so I would just say, whether I know AI is a looming threat on the horizon, and I get it, and we're trying to navigate our way through it. But I would also say, as we've gone back and you look at the previous years, managed services, we went from break fix to managed services, and then we had the cloud, and then that was, who knew what that was and how we're going to work on that, and we got through the cloud, and then we got through cybersecurity, and yes, we're here with AI, but business has always found its way through all of these industry disruptors. And so yes, it forces us to be nimble. Yes, it kind of weeds out the flock a little bit as we do that. But I would say, as you look at the market, don't be intimidated on that. When I look at even the numbers that we put up there, Taylor, look, the reality is this: if you're a top quartile firm, you will always be at the top of the range. That is what you control. And so work at becoming that. And I would say the people that have timed the market the best have generally been those who just got to the place they're running an optimum firm, and then they waited for the right timing, right? And so it's almost impossible. In fact, if we were to go back 6 months ago, neither Corey or I would be sitting here. You know what? Q1 at 26 is going to be the top of the market. It was like, oh my gosh, the market went here. We didn't think it was going to go here, right? And so I really think the key message I want to leave for all of you is build a thriving business that's going to be running in that top quartile, that's high recurring revenue, great profitability, has a good organic growth rate. It's not dependent on you work through your owner dependencies, you have good financials, all of those things that make a MSP great, and then organically grow your way to it. And then if your timeline does not allow you to achieve your personal wealth targets through a good organic growth strategy, then take a look at some of these other strategies. Maybe I should do acquisition. Maybe I should merge with some peers of mine and really now help get to a critical mass. But I think it all starts with what you can control, and that is how you operate your business and making sure that you're making the most of that. You're probably your greatest asset in your portfolio.
A little simpler individual than Reed. I would just boil it down. All that being said, I think everybody right now is looking at all these pieces and we're all chasing these shiny objects. But at the end of the day, while we work in a technology space, it's still a human business, right? So I would just remind everybody to stick to the fundamentals as it relates to supporting their client and their employee needs, because at the end of the day, we're going to continue to go through evolutions in the business, but it is still a human business. So I just always often have to remind us and our clients, like, there's a lot going on, but don't forget about what actually makes you special. And a lot of times that's built around the culture and the business that you've had. So
All right.
Awesome. Well, thank you all again today for attending. I hope it was a valuable discussion, and thank you to Reed and Corey for all of their insights. We will send out the recording this afternoon, and I'll also include Reed and Corey's contact information if you'd like to continue discussions offline. And any other questions we'll get to, we'll follow up with you as well. So thanks again, everyone, and hope you have a great rest of your Thursday.